Have you ever stopped to think about how our incredibly complex financial world actually got here? I mean, it wasn't designed by some committee in a quiet room. Nope. It was forged in chaos by individuals so powerful they could literally hold the entire American economy in the palm of their hand. This is the story of how a world run by titans gave way to a world run by systems. Our story really kicks off with this image. Just look at the scale of it. You've got the massive, imposing structure of the JP Morgan building. And then down below, these tiny human figures just scurrying past. It perfectly captures this huge shift, the moment when the individuals started to get dwarfed by the massive, powerful financial machine they had created. So here's how we're going to break this all down. We're going to start at the very beginning with the invention of money itself. Then we'll meet the titans who basically built American capitalism. We'll zoom in on the one man who was Wall Street, see what happened when his one-man system finally broke, and then look at how the modern financial world was built from the rubble. Right, before we can even get to the skyscrapers and the stock tickers, we have to go way back. Because the basic tools of finance, the very ideas of money, credit, and banking, well, they had to be invented first.
Okay, so let's get one thing straight about money. It isn't actually worth anything on its own. It's just a promise. A great example is the Spanish Empire back in the 16th century. They found a literal mountain of silver in Potosi, that's modern-day Bolivia, and they flooded Europe with it. You'd think that would make them rich forever, right? Wrong. It caused massive inflation. All that new money was chasing the same amount of stuff, so prices just went through the roof. It proves the point. Money's only worth what you can buy with it. And that idea of a promise, well, that's the whole game when it comes to credit. See, in medieval Europe, lending money was a super risky business. You were just one bad loan away from getting wiped out. The big innovation came during the Italian Renaissance with families like the Medicis. They created the first real banks, and they brought two game-changing ideas to the table: scale and diversification. By handling tons of loans, they could spread out the risk. One default wouldn't sink the ship. And just like that, lending went from a shady back alley deal to a pillar of the economy.
Okay, let's fast forward to America's Gilded Age, because this is where those financial tools got put to use on an epic scale. This era was one of just explosive growth, but man, it was also the Wild West. There were hardly any rules, and the guys building the country's economy were these ruthless, brilliant visionaries who pretty much lived on the edge of the law. And these were the four heavyweights of the era. You had Andrew Carnegie in steel, an industrialist who'd crushed rivals without a second thought. John D. Rockefeller, the monopolist who controlled nearly all the oil with Standard Oil. Jay Gould was the master speculator on the stock market, a guy so notorious his schemes actually led to new regulations. And then you had JP Morgan. He was the banker, the one who controlled the money. So while all those other guys were building industries, JP Morgan was building the financial plumbing that controlled all of them. He was, for all practical purposes, America's central bank long before we actually had one. And that incredible power was about to be put to the ultimate test. Morgan had this signature move, and they even named it after him: Morganization. Here's how it worked. He'd find a chaotic, failing industry, like the railroads, he'd take it over, and then he'd just impose brutal order. He'd slash costs, force competitors to merge, and roll everything up into a massive monopoly called a trust. He created order by eliminating competition, and it made him the most powerful financier on the planet. To get a sense of just how powerful he was, just look at this number: $1.4 billion. In 1901, Morgan engineered the creation of U.S. Steel. It became the world's very first billion-dollar corporation. To put that in perspective, that was more than the entire federal budget of the United States at the time. One company, created by one man, was worth more than the entire U.S. government's budget. But here's the problem. When you concentrate that much power and responsibility in one person, you create a massive vulnerability. The entire American financial system was basically a skyscraper built on the judgment and capital of a single guy. And in 1907, that foundation started to crumble. The Panic of 1907 kicks off with a series of bank runs. When everyone fears a bank is going under, so they all rush to pull their money out, which, of course, makes the bank go under. The whole system was about to collapse, and there was no Federal Reserve to call. So what happened? JP Morgan literally called the heads of the biggest banks to his library, locked the doors, and told them they weren't leaving until they agreed to pull their own personal fortunes to bail the system out. He single-handedly decided which banks would survive and which would fail. He stopped the collapse. So,
Morgan was hailed as a hero in 1907, and he was. But his dramatic rescue also revealed a pretty terrifying truth. The U.S. economy had just gotten too big, too complex to be saved by one person, no matter how rich or powerful they were. And the very next crisis would prove that point in the most devastating way possible.
By the late 1920s, the mood was euphoric. The roaring 20s were in full swing, and it felt like everyone was getting rich in the stock market. The optimism was so widespread that prominent economists like Irving Fisher were saying things like this just days before the whole thing imploded. But this whole boom was built on a shaky foundation of speculation and borrowed money. It was a bubble just waiting to pop.
And boy, did it pop. On Black Thursday, the panic selling began. A group of bankers tried to pull a JP Morgan and buy up stocks to show confidence. And it worked for about a day. The next week, the selling came back with a vengeance, leading to Black Tuesday. The market just completely collapsed. The old trick that worked in 1907, this time it was like trying to stop a tsunami with a beach bucket. It was useless.
The fallout was nothing short of an economic apocalypse. This wasn't just some numbers on a screen on Wall Street. It crippled the entire country. In just 3 years, from 1929 to 1932, America's industrial production was cut in half. Unemployment shot up to 25%. 1 in 4 people were out of a job. Generations of wealth gone in an instant. The Great Depression was a brutal, painful lesson. It became painfully obvious that the old way of doing things, relying on the wealth and whims of a few powerful men, had failed on a catastrophic scale. Something new was needed. The big takeaway from both of these crises was crystal clear. You couldn't have an economy this big teetering on the shoulders of one guy. It needed a permanent, impartial mechanism to keep things stable. It needed a system that was bigger than any one person. And that's exactly what happened. The legacy of these crashes is the financial world we live in now. The Panic of 1907 led directly to the creation of the Federal Reserve in 1913, specifically to be the lender of last resort that JP Morgan had been. And the 1929 crash led to all the New Deal regulations that put guardrails on banks and markets. The power officially shifted from the man to the institution. And really, this is what it all boils down to. In 1907, when Wall Street was on fire, the person they called for help was JP Morgan. Today, when we face a financial crisis, the institution that steps in is the Federal Reserve. The role of savior was transferred from a man to a mechanism. Which leaves us with a pretty big question, doesn't it? We got rid of the unpredictable judgment of these powerful titans and replaced it with a system of rules and institutions. We built a machine designed to be more reliable, more stable, and ultimately safer. But as we've seen in more recent crises, that machine is unbelievably complex, and it can create brand new risks nobody saw coming. So you have to wonder, is the system we have today really any safer than the one it replaced?